Know China to do better business. Save time and money with expert insights on China trade and investment. Welcome to our channel, Trade with China. Welcome to our channel, Trade with China. Today, we're going to decode the latest economic data and journalist questions response released on October 20th by National Bureau of Statistics of China.
That's right. And our mission today is really to cut through all that data. The Q3 and September numbers just dropped. It's a lot to digest.
Absolutely. Hundreds of billions of yuan. It's easy to get lost.
Exactly. So we're here to kind of separate the signal from the noise, give you, our listeners, clear, actionable insights. What does this data actually mean for your investments, for your trade decisions?
Okay, let's start at the top then, the big picture. Overall GDP for the first 3 quarters of 2025.
Right, the headline number. It came in at 101.5 trillion yuan. That's 5.2% real growth compared to last year. On the surface, pretty stable.
5.2%. That sounds quite robust, actually.
It does, but when you dig a little deeper, you see the pace is actually slowing down a bit.
Oh, how so?
Well, if you look quarter by quarter, real GDP growth was 5.4% in Q1, then it dipped to 5.2% in Q2, and in Q3 it landed at 4.8%.
Ah, okay, so a definite downward trend through the year. What's behind that?
The official word, and it seems to match the consensus, is it's a mix. Complexities externally, global demand issues, plus these ongoing deep structural adjustments happening inside China's economy.
So with those pressures, what actually propped up growth in Q3? What kept it from falling even further than 4.8%?
Good question. It was overwhelmingly domestic consumption. Final consumption expenditure was like the main engine.
Really? How much did it contribute?
A huge amount. It accounted for 56.6% of GDP growth in Q3. Just consumption alone pulled the overall growth rate up by 2.7 percentage points.
Wow. So when other areas are struggling, people spending money at home is really the key support.
Exactly. It acts as a buffer, a shock absorber.
Now, something you touched on earlier, the difference between real and nominal growth, this seems really important. You said real growth was 5.2% cumulative.
Right, but the nominal GDP growth, which includes price changes, was only 3.7%.
Okay, so a 1.5 percentage point gap. What does that tell us? It feels like it hides something.
It tells the story of deflationary pressure. It means, while the volume of stuff being produced is growing, that's the real 5.2%. The prices companies are getting for that stuff are significantly lower.
I see. So output volume is up, but price levels are down or stagnant.
Precisely. And that's crucial for investors because it means company revenues aren't growing nearly as fast as production volumes might suggest. It hits their pricing power, squeezes profit margins, even if some policies are starting to work on prices overall.
Okay, let's pivot from consumption to production, the industrial side. This is where those structural shifts seem really visible. Overall industrial growth was, what was it?
Decent.
Yeah.
6.2% year on year for the larger enterprises. But that average figure hides where the real action is.
Which is where?
It's all about what Beijing calls the new quality productive forces. Think innovation, high-end manufacturing, digital economy, green tech. That's the focus.
And the numbers show that.
Absolutely. Equipment manufacturing output, up 9.7%. High-tech manufacturing, right there with it, up 9.6%.
So those key sectors are growing roughly 3.4 percentage points faster than the industrial average. That's a significant gap.
It really is. You can practically see the policy direction and capital flow in those numbers, shifting from old to new.
Any specific examples of products driving this? You mentioned some cool facts earlier.
Yeah, the specific product output figures are pretty telling. Like 3D printing devices soared 40.5%, industrial robots up almost 30%, 29.8%, new energy vehicles still growing strong at 29.7%.
That's not just small adjustments, that's a major industrial transformation underway.
Exactly, it's policy driven, targeting these specific high-value areas.
But here's the question, if they're making all this advanced stuff, is it actually boosting company profits yet? You mentioned margin pressure.
Yeah, that's the slight disconnect right now. Total profits for the big industrial firms, looking at the first 8 months, were only up 0.9% year on year, just barely positive.
So output is booming in key areas, but profitability isn't quite there yet. Why the lag?
It's likely that deflationary environment we talked about, plus really intense competition within China. They're making more, but maybe selling it cheaper or having higher input costs that aren't fully passed on yet.
But is there optimism things will improve?
Definitely. That's maybe the key takeaway here. The forward-looking indicator, the Production and Operation Expectation Index from the PMI survey, it jumped up to 54.1% in September.
Okay, 54.1%. That's well into expansionary territory.
Right. It signals that businesses themselves are feeling more confident. They expect the policy push and maybe stabilizing prices to translate into better performance soon. That optimism is crucial.
Crucial indeed, especially for anyone trading with China. Let's talk trade then. How's it holding up, given the global picture?
It's showing resilience. Total imports and exports for the 3 quarters grew 4.0%, reaching about 33.6 trillion yuan.
4.0% overall, but I recall you mentioning an imbalance.
Yes, a very noticeable one. Exports did well, growing 7.1%, but imports actually shrank slightly, down 0.2%.
So China is exporting much more than it's importing, widening the trade surplus.
Correct. And another really important shift, especially for traders to note, is who is doing the trading.
Go on.
Private companies. They are increasingly the dominant force. Their trade grew 7.8%, significantly faster than state-owned enterprises. And they now account for 57% of China's total trade. That's up 2 percentage points just from last year.
Interesting. So the dynamism is coming more from the private sector and international trade. What about what they're trading?
It reinforces that move up the value chain. Mechanical and electrical products exports surged 9.6%. These aren't low-end goods anymore.
And their share of total exports.
It's now the clear majority.
Yeah.
60.5% of everything China exports falls into that mechanical and electrical category.
And geographically, are they diversifying away from traditional markets?
Seems so. The data highlights trade with Belt-and-Road countries grew 6.2%. That suggests these markets are providing some cushion as demand perhaps wavers elsewhere.
Speaking of elsewhere, what about the U.S.? That relationship is always critical.
Yeah, the specific analysis, like from CMB, shows a stark contrast. Non-U.S. exports were actually quite strong, showing month-on-month resilience up nearly 15% in September alone.
Wow, 15% month-on-month for non-U.S.
Yeah, but exports to the U.S. still contracting. The decline narrowed a bit in September, but it was still down 27% year-on-year.
Okay, so that decoupling or diversification trend, particularly away from the U.S. market, is definitely accelerating in the trade data.
Seems clear.
All right, let's bring it back home. Domestic demand. We talked about consumption being the main driver in Q3. How did retail sales look overall?
Steady. Total retail sales up 4.5% for the first 3 quarters. And service retail, things like restaurants and travel, grew even faster at 5.2%.
Were there specific policies helping that?
Oh, absolutely. You can really see the impact of targeted stimulus. The government pushed these trade-in programs for consumer goods.
Right, swapping old appliances for new ones.
Exactly. And look at the numbers. Sales of household appliances rocketed up 25.3%. Furniture up 21.3%. Communication equipment like phones up 20.5%.
Those are huge jumps, clearly policy-driven.
No doubt. And online retail kept growing steadily too at 9.8%. So consumption looks reasonably healthy, helped by specific measures.
Okay, now for the flip side of domestic demand, investment. This seems to be the weak spot. Fixed asset investment or FAI?
Yeah, that's the main drag right now. Overall, FAI actually dropped 0.5% in the first 3 quarters. That's a worry.
A drop. Why? What's pulling it down so much?
It's almost entirely one thing. Real estate, the property sector crisis is still weighing heavily. Investment in real estate development plunged to 13.9%.
Minus 13.9%. Ouch.
Yeah. And sales are down too. New commercial building sales value dropped 7.9%. So that whole sector is just acting like a massive anchor on overall investment.
But is that the whole story for investment? If we sort of mentally remove the real estate black hole, what does the rest of investment look like?
Much better, actually. If you exclude real estate development, FAI grew by 3.0%. Not spectacular, but positive.
Okay, 3.0% growth outside of property. And where is that investment going?
Again, it lines up perfectly with the new Quality Productive Forces strategy. It's hyper-focused. Investment in high-tech manufacturing was up. But look at high-tech services.
Like what?
Information services, FAI, think software, IT services, data centers, it surged an incredible 33.1%.
33%, okay.
Yeah. And things like aerospace and equipment manufacturing, FAI, also saw strong growth, up 20.6%. So capital isn't just sitting idle, it's actively moving out of property and into these strategic government-backed sectors very rapidly.
That's a really clear picture of structural change. Okay, last piece of the puzzle, prices. Given the nominal real GDP gap and the property slump, how are inflation or deflation pressures looking?
This is where there's some perhaps cautious optimism for policymakers.
Yeah.
Overall CPI, the Consumer Price Index, was slightly negative, down 0.1% year-on-year in September. Still deflationary pressure there.
Right, minus 0.1%.
But the key indicator to watch is core CPI. That strips out the volatile food and energy prices, and that rose to 1.0% in September.
Okay, 1.0% for core CPI. Is that significant?
Yes, it's the highest it's been in 19 months. It suggests that the policies aimed at boosting domestic demand are starting to gain traction, stimulating underlying price pressures away from outright deflation.
That's a potentially positive sign.
Sure.
What about producer prices, the PPI? Prices at the factory gate?
Also improving, or at least stabilizing. The PPI decline narrowed quite a bit. It fell 2.3% in September, which sounds bad, but it's actually a 0.6 percentage point improvement from the month before.
So the deflationary pressure on producers is easing somewhat.
Exactly. Things are getting less bad, which helps corporate margins. The official report even partly credits some anti-overcompetition measures for helping stabilize those prices.
Okay, so we've covered a lot of ground. Let's try to pull this together. What are the main takeaways for investors and traders looking at this data?
Right, let's synthesize. First, for investment, the economy is clearly in a phase of, let's call it, structural repair, and shifting from old growth drivers to new ones.
We saw that starkly. Capital leaving real estate. FAI down 13.9% there. Overall private investment down 3.1%.
But flooding into high tech. Remember that 33.1% jump in information services FAI.
Unforgettable. So the implication for investors.
Pretty straightforward. Follow the policy signal. Align your capital with where the state is directing resources. High-tech manufacturing, green transition initiatives, equipment upgrades. Those sectors have clear policy tailwinds and are getting the funding.
Okay, takeaway one, invest with the policy shift. What's the second?
For trade strategy, it's about resilience and diversification. External demand, especially outside the US and maybe Europe, is holding up, driven by places like the Belt and Road countries.
And China's export structure is changing fast, dominated by those mechanical and electrical goods, 60.5% of the total.
Right. So traders need to brace for continued volatility, especially US-China friction, maybe new tariffs, that sort of thing. But the real opportunities are in plugging into those specialized, high-value manufacturing supply chains where China is building strength.
Got it. Trade takeaway. Manage volatility, focus on high-value niches and diverse markets. What's the third key point?
It's about the policy environment itself. The goal right now seems to be stabilization.
Evidence being the core CPI finally hitting 1.0% and the PPI decline narrowing.
Exactly. It suggests the targeted fiscal and monetary levers are working, at least somewhat, to fight deflation and boost confidence. Remember that rising business expectation index, too.
So what should we expect policy-wise going forward?
Probably more of the same, but very targeted. Expect continued refinement of consumption support, like maybe expanding those trade-in programs, and likely more focus on funding specific types of infrastructure, especially the new infrastructure linked to tech and green goals, to offset weakness elsewhere.
So summing up, it's a complex picture, definite challenges, especially the property sector drag and external uncertainties, but also clear signs of a determined structural shift.
That's the bottom line. Don't get too caught up in the quarter-to-quarter GDP fluctuations, which are heavily skewed by the real estate unwind right now. The fundamental story, the provocative thought perhaps, is this deliberate, rapid pivot towards what they call new quality productive forces.
Innovation, green tech, digital economy.
Yes. That push suggests China is building long-term structural resilience and aiming for a different kind of competitive advantage, almost irrespective of near-term GDP numbers. That underlying shift is what long-term investors and strategic traders really need to watch.
A fascinating perspective. Thanks for breaking that all down.
My pleasure.
This channel will bring you practical knowledge to navigate business, investment, culture, economic trends, and communication tips and trades with China. Your comments really encourage us to realize our video value and update more useful information. Please press like, subscribe now for actionable insights and win-win solutions. Not to miss the possibility to understand and make money in trades with China.